Welcome to Market Catalysts. I'm Julie Hyman. Here is what we're watching today. First up, IBM will buy Confluent for $9.3 billion. We'll be speaking with the CEO of Confluent to discuss. Plus, the bidding war for Warner Brothers heats up as Paramount makes a hostile bid for the company. And we'll count you down to the December FOMC meeting as the Federal Reserve prepares to issue a rate decision. Let's take a look at the major averages. It is already a busy week. It's going to be a busier week as we get that decision from the Fed, as we get earnings from Oracle and Broadcom. Ahead of all of that, pretty quiet here today because investors are waiting for the news here. But we've got the Dow right now down about 75 points or so. The S&P 500, very little change to the downside. The NASDAQ composite is up about 0.1%. I'm going to check on over here quickly at trending tickers to see if we've got some of the companies involved in that bidding war on the list here. Maybe we'll have to scroll down to see them. I'm not seeing them here, so we'll get a check on them as the day goes on. But let's look at the sectors within the S&P 500 here, because there we have tech that is to the upside here today, up about 0.8%. Utilities, healthcare, consumer staples on the downside, a much more downward breath here today, even though the S&P 500 overall is a little changed. You got some groups that are fairly deeply in the red here today. It's a mixed picture for large cap tech today. You've got Broadcom trading higher along with Microsoft, but some of the other large cap tech names are under some pressure. Tesla, which is getting a lower price target over at Morgan Stanley from the new analyst who is covering that. We talked about that a little bit earlier in the day. So that also causing some pressure here. I'm going to see if we've got our media full screen our media heat map rather, that we can check on to see if we can check on what's going on in those stocks, but I'm not seeing it, so I'm going to move on and we're going to broaden it out. Because you might remember the so-called Vibepression that we talked about last year when economic data was relatively good, but consumer sentiment was not. Get ready now for the Vibepression. I'm joined by Kevin Gordon, Charles Schwab Director and Senior Investment Strategist. And Kevin, it was Kyla Scanlan, who is an economics writer and blogger, who first coined Vibepression, right? And this was something that was sort of confounding to economists for a while, right? The data's good. Why don't people feel better? Well, guess what? They still don't feel good. So is it gotten worse? Is that why it's now a Vibepression instead of just a Vibepression?
Yeah, it's more of this sort of depression of sentiment. I think, we're 4 to 5 years in this cycle now, really sort of a secular change in the backdrop where even though inflation-adjusted GDP has made highs from year to year, ever since 2020, you've also seen, asset markets do relatively well, not without a lot of volatility. You've seen relative stability in the interest rate world. Despite all of that, you still have sentiment metrics that are near or at all-time lows. And I think even for something like the University of Michigan's Consumer Sentiment Index, if you look at the current conditions part of that index, it made another new all-time low on Friday. So you literally have a swath of consumers saying that this is the worst that they've ever seen the economy. Worse than the Great Recession, worse than 2001, worse than the 90s, so on, the early 90s, so on and so forth. So I think that you can now start to call it more of this depression in sentiment. But to your point about the economics and the hard data, it's still looking okay. We expect that split to persist, where you do have the economy continuing to grow, even if it's not at that remarkable of a pace. You could still, I think, see that instance where the economy continues to grow, but the vibes stay terrible or actually get a little bit worse.
Well, and are the people who are still feeling terrible? I mean, we talk a lot about the K-shaped economy. Is it the lower income exclusively, or are there also folks who are middle and upper income?
Well, that's it's not exclusively lower income. I mean, there's so many individuals or groups of people that populate that lower end of the K. I would put younger people into that as well. And that's, I think, more of the second phase of the Vibepression turning into a Vibepression. At first, it was really just dominated by inflation. You had that massive spike in 22 and 23 that sent price levels, egregiously above where they were before the pandemic. You still have a lot of consumers that talk about that. That's very central to the affordability issue. Now it's translating more into the labor market. This low hiring, low firing nature of labor has, disproportionately hit people who are younger in the workforce, because if you're not seeing a lot of companies that are hiring, you're not getting a lot of people coming out of school. That sort of breaks that mechanism that is traditionally, pretty strong. So I think that it's now being populated more by not necessarily just low income or people that have, less wealth. I think it's also now, people who just can't find a job, even if they're very much willing to do so.
Okay, so how, as you say, it's gone on for a couple of years. The stock market has mostly continued to go up. How can that just happen indefinitely? And what needs to happen? Like, what would be a tipping point that you would be watching for? Or do you think it's not going to happen?
Well, I think the tipping point would be if you do see a full transition spill over into the labor market, where you do see more softening, where actual, aggregate payrolls, the stock of payrolls starts to decline meaningfully. I think that this current sort of uncomfortable situation we're in right now, where payroll growth is very sluggish, basically zero if you average it over the past several months, but the unemployment rate has not moved up considerably. It's moved up over the past year, but 4.4%. It's pretty consistent with what a lot of economists think is a fully employed labor market. So if that situation and dynamic doesn't change much, then I think that the sentiment stuff is not necessarily going to be a leading indicator of the broader economy. And that's why I talk about this sort of secular break that has happened between those two data points, because typically, just look at household net worth as an example. If you take that relative to GDP and you mapped that over sentiment over time, they tend to follow each other, which is intuitive, very much in keeping with what you would expect for any economic data point. Both of those have now completely broken from each other. So you haven't been able to rely on sentiment or confidence as this leading indicator for the economy. I think that it's shifted a little bit more in favor of business confidence, maybe being that still maybe a loose leading indicator. But even with that, a lot of businesses are still plagued by the inflation backdrop that has been, been with us over the past few years. So I don't think that you can just use that as a traditional leading indicator in this cycle. It'll probably change, hopefully in the future, where we can rely on it, but it just hasn't been the case over the past 4 years.
Okay, put all that together then and talk to me about your stock's outlook for 2026, given that backdrop.
So, it's interesting because the earnings backdrop actually looks relatively healthy. If you're looking at estimates for the full year of 26, there's only 2 sectors that are expected to show negative growth in earnings. So revisions breadth has been pretty strong, and that's leading to, I think, a firmer backdrop for, the rest of the market outside of just the mega caps. So when we think about some of the dynamics specifically within, the AI space, there's probably more, runway for the rest of the market to continue to do well. And I think you're starting to see that manifest over the past month and a half, where some of this year's laggards have really started to catch up. And it's not just a defensive play where only healthcare is doing well, because that was really sort of thrown in the waste bin by the middle of this year, where it had reached a multi-decade low relative to the S&P 500. But it's starting to spread into other areas that are a little bit more cyclical in nature. Energy, specifically oil and gas, but also parts of financials, even parts of consumer discretionary. So there is a little bit of a firming of a backdrop there. I will say, though, participation is still really weak. You've got about 30% of the members in the S&P 500 outperforming the index over the past 3 months. So that really needs to pick up, I think, heading into 26 for you to enter the year and start the year on a little bit of a firmer, footing. But it's not impossible. So we think that because of the earnings backdrop staying relatively healthy, barring some major, I think, volatility driver from a tariff perspective, you can still continue to see, the market churn higher.
Now, you guys at Schwab have talked for a while now about quality stocks, being that that's an important metric. And what does quality mean? Well, it's a solid balance sheet, it's consistent earnings growth. Without going too far into the weeds, there was an interesting story in the Journal this morning talking about the definition of quality. And I guess I would just ask you this. How much do regular investors need to know about depreciation accounting at this point as it pertains to technology and that definition of quality?
Well, for tech, it does become more part of a more central part of the story, because tech companies are now becoming a little bit more capital heavy, which is very different than what has been the case over the past 10 to 15 years. The software cycle has really dominated pre-AI craze, and now it's starting to manifest more on the hardware side and the actual equipment. So I do think that aspect of things has changed a little bit for that sector. But in terms of quality from a profit margin standpoint, I don't think that has changed. And I think that's one of the points that we've really been making to investors, is to look for that margin strength, especially because so far this year, when you go back to April and you look at, really the sort of dour outlooks people had in terms of tariffs and how much they were going to eat away at companies. Yes, that's been the case down the size spectrum for small businesses, but when you look at the larger companies, especially the ones that dominate the S&P, it just hasn't been the case because they've had relatively strong margins. They've also been able to work down pretty solid inventory growth. You combine those two together and you still have a healthy backdrop, and it's basically the reason we're sort of right near all-time highs again. So I think that from a profit margin standpoint, I don't think that really changes in terms of looking at quality. That said, though, for investors who are looking at an index that's labeled quality, that doesn't necessarily mean that the product is screening just for profit margin strength. So you do have to look at what's in there, and you have to look at the individual scoring for some of the members and see what they're actually using as criteria to put those members in.
When you look at next year, is there a particular sector that you think really has the opportunity to break out to the upside?
So we're relatively constructive on areas like industrials, healthcare. I think that even with tech being rated sort of as a market perform for us, still remaining in the neutral category, I think you have to keep in mind what has sort of become the norm over the past couple of years goes through these digestive corrective phases. Tech just had a correction most recently, almost exactly 10%. But some of those snapbacks and subsequent rebounds can be pretty aggressive and pretty strong, and it can actually account for sometimes most of that sector's gain for a year. So it's important to keep in mind in terms of owning it versus getting really aggressively bullish on it and extending your position. But we think that generally shifting from areas like the hyperscalers and just a mega cap play for something like AI, but moving into some of the adopters of the technology, whether that's in healthcare or industrials or even to some extent parts of the consumer space. Consumer discretionary we're still quite negative on, but if you look at some of those areas within that sector that can benefit from some of the technology that have thinner margins, we still think that there's a pretty solid runway for those. So we'd focus on that a little bit more, not completely at the expense of the big cap tech stuff, but at least in conjunction with it.
Kevin, great to see you.
Good
Thanks
to see
so
you.
much for coming in.
Thank you.
Appreciate it. Coming up, the Federal Reserve is expected to announce an interest rate cut this week. What Powell's commentary could signal about the path forward for next year. Stay tuned. You're watching Market Catalysts. Markets are pricing in about an 89% chance of a rate cut this week, according to CME FedWatch. Our next guest says we should watch for a hawkish shift in the forward guidance language. Joining me now is Stephen Junot, BofA Securities Senior U.S. Economist. Stephen, good to see you as always here. So we're looking for this rate cut. But probably more importantly, we're looking at the guidance and we're also looking at the dissents. So what are you going to be watching most closely on Wednesday?
Yeah, so I think on the guidance, two things. I would say first is the statement. Do we see a change to the forward guidance just explicitly there? Do they write something like the extent and timing of any additional rate cuts? Or do they say any additional rate cuts? So leave out that extent and timing. Any would probably be a little bit more hawkish because it would imply that maybe they're not going to cut further. Extent and timing still implies some cuts at some point. But I would say look for that, right? And that would be more about Powell kind of getting agreement amongst the hawks, because there's a number of hawks on the committee right now who aren't super supportive of kind of easing rates further. We got that dissent in October from Schmid, the regional president of Kansas City. He'll probably dissent again to another cut this meeting as well. Then on the dissent side, I would say you'll have Myron dissent again, obviously in the dovish direction because he wants to cut faster. That's been what he's done since he's got into the FOMC. And Schmid, again, of course, will probably dissent in the hawkish direction. But I wouldn't be surprised if you see one other regional voting president join Schmid this time around, because of the voters right now, Goolsbee, Collins, Muslim, they're all a little bit on the hawkish side right now. So it will be kind of a balancing act for Powell to convince these people that it is right to kind of continue to cut rates in this environment.
Stephen, obviously, they're having a tough time coming to an agreement here. And I think that those folks in your profession are maybe having a tough time grappling with the two sides of the dual mandate too. Is it an unusually difficult time to figure out whether inflation or the job market is more acute right now?
It is. It's incredibly difficult because the economy, both are being basically shocked by supply shocks, right? And the Fed typically looks through supply shocks. So on the labor side, we're going through these changes of immigration policy. That's leading to less labor supply growth. And maybe we think at least that's a big reason why we are seeing this slowdown in hiring. Now, of course, the unemployment rate has ticked higher. There's AI out there too to consider. So there's a lot of kind of these supply side shocks going on. Then on the inflation front, you have tariffs, another kind of supply shock. So you're trying to parse through this data and figure out, well, yes, one, I don't really have real-time data to begin with because of the shutdown. I'm working with September data. But two, of the data that I do have in hand, how much of this is kind of demand driven? How much of this is supply driven? And then which one do I emphasize more, right? So it's a very challenging time because when you do have these type of supply shocks, well, the risk is that you end up in kind of a stagflationary scenario. And with the Fed's dual mandate, a stagflation scenario, it's just very hard to kind of figure out which of the two mandates you put more weight on, you know? So that's where it is a challenging time. to get consensus. So it's no surprise, I would say, that we'll see more dissents. We'll probably see more dissents in the year ahead as policy just continues to be very hard to kind of navigate and figure out what is the right focus for the Fed these days.
Well, and Stephen, we've been having some other interesting discussions around the Fed today. And I earlier talked to a strategist, and certainly she's not the first one who has said this, that the relationship between the Fed easing policy and the transmission to the consumer is sort of broken. That we're not seeing that stimulative power that we once saw here. So when the Fed cuts rates, what can we expect to be sort of the effect on the economy?
Well, I think that's a fair point in many ways, because you're not really, when you think about the Fed hiking rates, you didn't see that contractionary force put down on the consumer because, of course, what we saw was mortgage rates really didn't move, at least the effective mortgage rate. What people were actually paying didn't move. Yes, the spot mortgage rate did, but most households just held on to their sub 4% mortgage rate, so they weren't facing kind of the burden of higher rates. Now, I do think you'll see some effects on the business side when you think about small, medium-sized businesses, maybe borrowing at overnight rates plus, plus some type of spread, right, a prime rate. So you're going to see some effects there where there will be some easing, but will it be kind of super stimulative if the Fed cuts by 75 basis points this year? Probably not, but on the margins, it's more stimulative than if they didn't. And of course, what's also kind of limiting this is the 10-year, right? The transmission is being limited by the fact that the 10-year rates are range bound. And these are rates that truly affect the economy and the consumer. And those are range bound for a number of reasons. The fact that we have more treasury supply out there, the fact that we have maybe a little bit softer demand for treasuries as well. So that puts upward pressure on the 10-year through a higher term premium. So again, this limits the transmission mechanism. I don't think it's completely broken, but I would say the efficacy of cutting rates today isn't necessarily as powerful as it has been maybe historically.
Stephen, I also wanted to ask you about Fed personnel, and for once, I'm not going to talk about the chair. I'm going to talk about something else that Scott Bessent, the Treasury Secretary, has recently talked about, which is potentially implementing a new rule that requires that the regional Fed presidents have to have lived in their region for, I think it's 3 years before they are nominated. What kind of potential effect could that have on the composition of the Fed?
Well, I appreciate you not bringing up kind of the Fed chair race today, but it's interesting, right? Because I think it's what he mentioned was that it wouldn't be on a retroactive basis. So could it affect who's selected for the Atlanta Fed president to replace Raphael Bostic or President Bostic? Absolutely, but I don't think it would lead to a big shakeup the way it's implemented. And then I think right now, if you don't kind of write it into the Federal Reserve Act, it wouldn't necessarily apply on a broad basis. It would really be up to the discretion of the boards of directors that actually are involved in the search committee and selecting these regional presidents. So really I would say it might affect the next Atlanta Fed president. Outside of that, I don't think it will have a material effect in the near term because the next regional president that's up, I believe, is President Barkin out in Richmond, and his term's not up until 2028. So I don't think there's a big shakeup in the near term from this proposal.
Gotcha. But something to watch going forward into the further distant future. Stephen, good to see you. Thanks so much.
Likewise.
Coming up, we're taking a look at some of today's trading tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tabama. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Netflix, Apple, and Five Below. First up, Netflix shares falling today after Paramount made a $108 billion all-cash deal to acquire all of Warner Brothers Discovery. Now, Pivotal Research cited a bidding war as a key concern that could force Netflix to increase its $72 billion offer, and that led Pivotal Research to downgrade Netflix stock to hold from buy over the weekend. Now, the analyst said other concerns include regulatory approval uncertainty with an 18 to 24-month timeline to close. Now, that's on top of indications that Netflix management, well, it seems to be worried about competition from short-form content platforms like TikTok, YouTube Shorts, and Snapchat. For Netflix stock, there are now 40 buy ratings, 16 holds, and 3 sell ratings on the street. Next up, we're watching shares of Apple because Wedbush's Dan Ives raised its price target on the stock to $350, up from $320. That's now the most bullish price target on the street. The increase was based on strong iPhone 17 sales. He said sales have been trending well into year-end, including in the China region, with the ability to surpass Wall Street's expectations for a healthy holiday season. Plus, he believes that 2026 will be the year that Apple enters and delivers on its AI strategy, and that could be a boost for Apple stock. He believes there's no AI premium factored into Apple stock at current prices just yet. Lastly, Five Below, that stock moving higher this morning after the firm Truist upgraded its price target on the stock to $216, calling its recent third quarter results a turning point with gains in every category. Now the firm expects that to continue through early 2026, boosted by larger tax refunds and improvement in merchandising and value. The 12-month price target on Five Below stock is $185.50. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching new additions to the S&P, Strategy, and Marvell. First up, Carvana, CRH, and Comfort Systems. All of those stocks are popping after it was announced they'll be joining the S&P 500. The inclusion officially goes into effect on December 22nd. The S&P 500 index is rebalanced every quarter with new companies added if they meet certain criteria. Factors include things like market value, profitability, and sector representation. Next up is Strategy, a stock that to some controversially is not going in the S&P 500, at least not right now. The stock is down at the moment about 0.25% after the digital asset treasury company said it bought $963 million worth of Bitcoin. That is the company's biggest acquisition of the token since July. It comes amid a sell-off in Bitcoin. Strategy's Bitcoin holdings are now worth more than $60 billion total, but the premium to its holdings continues to narrow. And as a reminder, last week Strategy announced a $1.4 billion reserve fund to cover future dividend and interest payments. And finally, Marvell. Those shares are under pressure amid reports that Microsoft will shift its custom chip business to Broadcom from Marvell. That's according to The Information, which says Microsoft is in discussions with Broadcom to design future custom chips. That would be a move away from its alliance with Marvell. The stock was also downgraded at Benchmark today. The analyst there says the company has lost Amazon as well as a customer for some of its chips. Coming up, we'll hear from HPE's CEO about the company's latest earnings report. Stay tuned. You're watching Market Catalysts. HPE missing fourth quarter revenue estimates and issuing a weaker than expected forecast for the first quarter. Yahoo Finance executive editor Brian Sozzi spoke to HPE CEO Antonio Neri about those results.
Take us through the revenue shortfall, because initially I think that's where the market was focused. What happened there?
Well, Brian, thanks for having me. We had another solid performance in Q4, capping a very solid fiscal year 25, and our quarter was marked by record profitable growth, where we saw revenue up 14% year over year, maybe on the lower end of our guidance, but our operating profits were up 26% year over year, so growing faster than revenue. And then we delivered record performance on operating margins at 12.2%. And that combined allow us to exceed our non-GAAP diluted earnings per share by 2 cents at the midpoint, and most importantly, exceed our free cash flow guidance by $286 million. So what we saw there is, again, with additional Juniper, a strong performance. We are now a networking-centric company, and you can see that in the gross margin at 36%. But what I'm really pleased is the fact we've made remarkable progress in such a short period of time integrating Juniper. And that progress was demonstrated in two areas. One is, as a first combined networking business now, we grew on a pro forma basis out to the gate. And we delivered amazing innovation this past week at Barcelona, where we announced a number of breakthrough technology innovations in campus and branch switching, routing, and security. So all in all, a very strong quarter for us.
For the outlook, for the go-forward outlook, there was, some of the folks that I talked to on the street, they called out it's back-end loaded. You're expecting stronger sales in the back half of the fiscal year, as I guess it pertains to servers. What is going to happen in the back half of the year? What has to happen?
Well, we reaffirm our fiscal year 25 revenue outlook of 17 to 22% year-over-year growth on the back of the momentum we had in 25 in servers. We saw in the traditional servers double digits year-over-year revenue growth. We booked another $2 billion in AI system orders, skewed to sovereign and enterprise, which is our focus. Now more than 60% of the bookings are in sovereign and enterprise. And those take a little bit longer to recognize. That's why it's more back-end loaded. So our seasonality, including Juniper, now is 46% in the first half, 54% in the second half. So that's to be taken into consideration. But we also raised the midpoint of the networking revenue guidance now that we are confident on the milestones we have achieved in the integration to the mid-single digits. And also we raised the EPS and free cash flow guidance. Now the EPS guidance went up by 5 cents and the free cash flow guidance by 100 million. And in that guidance, by the way, Brian, we already factor in the commodity cost increases that we have seen, and we have line of sight to it. And we already enacted price increases in November. So we are very confident in that guidance. And as we said, in 2025, we will grow the company between 10 and 50%. We grew the company 14%. And this year we're going to do it again, but in a different mix with higher gross profits.
It sounds like towards the end of the current quarter, business started to improve for you or accelerate. What triggered that?
Well, we had strong performance across the three segments of the company. We saw an acceleration of order intakes in the networking business, as well as in the traditional server business. We continue to have a stellar performance in our own intellectual property in storage, where we saw 4 consecutive quarters of double-digit year-over-year orders and revenue growth. And we are very encouraged about the momentum we have. Remember, we exit the quarter with the highest backlog ever in AI at $4.7 billion. So this gives us the confidence not only on the financial commitments, but is sustained by the market demand and by our technology leadership.
You mentioned higher costs. Now I heard, and price increases. I talked to our mutual friend Enrique Lores, of course, the CEO of HP. He said the same thing. Of course, he's making PCs, you're making servers, networking equipment. Sure. What is exactly happening out there? Can you get the commodities you need? And what is in short supply? And why is it happening?
Well, it comes in two places, right? DRAM and NAND. And it's driven by the hypercycle we see in the AI business. And remember, there is a technology transition from traditional DRAM to the integrated memory inside the GPUs, which is called the HBMs. And so the wafer suppliers are now constrained on capacity to meet all the demands, because the demands is not only strong in AI through the hypercycle, but also in the traditional business. But we have a very capable scale supply chain with long-term agreements. We have put forward more than 52 weeks forecast with our suppliers, and I'm confident we're going to get the allocation supply that we need. But that drives, obviously, an imbalance between supply and demand, which usually results in cost increases. And we already saw that in calendar Q4, and we already implemented price increases and expect to pass the vast majority as we go into 26. Now, the NAND portion of that will follow as well. But remember, now being a more networking-centric company also allows us to be less dependent, because those commodities don't have the same impact in the networking business.
Have you started to take business away from Cisco?
Well, we have, as independent companies, we have taken share in the campus and branch. We are the company that shipped the most wireless access points year to date. And with our differentiation now in the AI ops, we believe we will continue on that journey. And there will be a refresh coming up on the campus and branch switching. And so what we announced this week at the HP Discover in Barcelona is the cross-pollination between Aruba Central and Mist AI. So both will get the best of both platforms. And we are also introduced the first dual infrastructure set of products that whatever journey you were on, whether Aruba Central or Mist AI, it will be supported with the same product infrastructure. And also we introduced the first industry liquid-cooled 1.6 terabit switch. So time to market with data center switching is super important. And that's because now the networking team and the leadership of Rami has the benefit of accessing direct liquid cooling from our server business, which for others will take a little bit of time, in addition to all the other announcements on AI for networks with AI Ops, agentic AI with our GreenLake platform. So super, super excited. And I'll tell you, the customers that we had in Barcelona, which were more than 5,000, record-breaking, were so enthusiastic about us building a new networking leader.
All right, well, take that, Cisco. Look, Antonio, since we've talked, there's been more or increasing talk about an AI bubble. Now, you are literally, I need your stuff to build out AI infrastructure in this country and around the world. Do you think the talk of this type of talk makes any sense based on the orders you're seeing, demand you're seeing, customers you're talking to, other CEOs you're talking to?
Well, I will say demand continue to be unabatable, and that's because I see now the adoption of enterprise rising. I give an example in my own company here. We have more than 100 use cases already in production using large language model or agentic AI models. And then obviously sovereign is accelerating. In Europe you can see it. The need for sovereignty, the need to protect the data, the need to build their own models is growing very, very rapidly. And then on the service provider space, whether it's hyperscalers or neoclouds, we see that continuing. And then the United States is investing pretty heavily in building the capabilities. And we already won 5 large AI and supercomputing business with the US government in the Department of Energy, which are going to be breakthrough systems that will continue to put the United States ahead of the rest of the world. Now, how you finance that, how you build these massive data centers, is you have to be prudent, right, where the funding comes from. But we as a company are very prudent in managing our working capital, so we are not exposed to any of that. We just focus on profitable growth where it makes sense for us.
As a company, as a very large tech company, of course, Antonio, are you concerned about circular financing?
Look, there is all sorts of speculation out there, where the financing comes from and so forth. What I can tell you is the raising of capital continues, but we as a company obviously have a HP Financial Services arm that are focused only on enterprise customers, because that's the market we serve with our IT asset lifecycle services. And so definitely, there are risks out there. But right now, I will say that the demand portion of the risk is very, very minimal.
Coming up, well, what to watch in big tech earnings from Oracle and Broadcom. They're on deck this week. That's next. Broadcom and Oracle both set to report earnings this week, giving a sense of where the big tech trade stands going into year-end. Oracle's major deal with OpenAI and use of debt has raised some concerns for investors, while Broadcom's role in Google's AI build-out could provide a boost. For a deeper dive, Bob O'Donnell, Technalysis Research President, is joining me now in the studio. Good to see you, Bob.
Good to see you, too.
So it does seem like of the big tech plays that are AI-linked, Oracle has been kind of the most controversial, right?
Well, they have. The issue is they're a very small player in cloud computing. They're about 3-ish%, depending on who you look at, of the total cloud computing market. They've done a couple interesting things. They've really focused on sovereign AI, or on sovereign workloads, which is becoming a big deal, and specifically on AI workloads. So they're trying to be a bigger part of that. But they have, kind of exclusively almost gone with NVIDIA, a little bit of AMD, whereas you see all the other big cloud providers looking at doing, custom accelerators, often with Broadcom. So Google's done that, AWS has done that, Microsoft is doing that, everybody else is, Meta's doing that. So they're kind of linked in there, and then of course they're also linked with OpenAI. And so years ago, a year ago, if it was NVIDIA and OpenAI, you're like, we're good. Now it's like, well, yeah, you're good, but I think there's just a sense of a desire for more diversity across the board, right? So we're seeing diversity in the silicon that's being used to accelerate AI workloads. There's a lot more interest. NVIDIA is still going to do great, don't get me wrong, but people are like, hey, you know what? maybe they don't have to have 90%. Maybe they only have to have 60% share, right?
Yeah.
And so building out all that other stuff. And then again, OpenAI is not the only game in town at all anymore. And so there's a lot of other things happening there. And, as you guys were just talking, as they were just discussing in the previous segment, that circular discussion on financing has not gone away. You and I talked about it, I think, last time I was here.
Yeah.
And that's just a real factor that has to be brought into this, because it does make things a little bit more uncertain. And as a result, and I know I was when I was doing some research, Jared did a nice piece last week on the credit default swaps and all the bonds and stuff that Oracle's using to finance this infrastructure. Again, that's another question I think that's been raised. So, the big question for them ultimately is, okay, how do they build that OCI business? Their software business is big and fine, but it's stable and flat, not really doing a whole lot. So OCI is where their opportunity is.
Okay, so OCI, which is its cloud computing business, what could they say on this call or in this report to ease concerns of investors? What do you think people are going to be paying the most attention to?
I think the big things will be around, obviously, other big clients besides an OpenAI, right? If they can nail a couple of big other big companies, and then overall growth. I do think, look, Oracle's had a very strong business in the enterprise for a long time. And again, this is, I think, a topic I talked with you about last time as well. Enterprise AI is a growing thing. Actual individual companies starting to build out their AI resources. And so, Oracle has that opportunity because of existing relationships with a lot of enterprises to potentially be a player in some of that. So that would be interesting. A big deal, with some other frontier cloud AI provider would be interesting. And, obviously Outlook is going to be a big deal for everybody, right, this week. I think that continues to be the big question.
Yeah, definitely. Okay, so Oracle is the one.
Right.
But then you have Broadcom also.
Yeah, and Broadcom is benefiting from that diversity I mentioned earlier, right? Because they have relationships to help design chips, Google being the most well-known, but also with OpenAI. We've seen them, you were just talking about it potentially with Microsoft as well. So there's a lot of opportunity because they become this additional, they're not built, it's not a Broadcom labeled chip. They partner with these other companies to help them design and create these chips. Right. And again, there's huge interest there. We've seen how well Google has been on a tear recently. Gemini's done very well. All of that is trained with their own TPUs, which are built in conjunction with Broadcom. So there is that opportunity. They too also have a big software business, kind of like Oracle. It's actually been growing a little bit, but obviously the big opportunity and the big question for the Broadcom call is going to be, hey, what's it look like for 26? And can they announce another big design win?
Do you think we'll get a confirmation of this Microsoft report?
Logically, if that's going to happen, it would seem like this call would be the perfect time to do it. So it wouldn't shock me. I can't say I know. Obviously, I have no idea. But it would be a logical step for them to do. And it would give them a nice hit, certainly in the interim. And then does it lay the groundwork for a stronger 26? Because, again, where everybody's talking, that demand is huge. It's out there. There are going to be challenges because of some of the shortages in DRAM and NAND storage, flash storage. That's going to make these, they're expensive already, right?
Yeah.
These racks can be millions of dollars. Sure. So now if it's millions plus, then okay, I guess maybe you can deal with that. But still, those are all factors to be considered in all of this. And will, then the big question for 26 in my mind when we think bigger picture is, all right, where are the business models, right? Where are the places the companies that are spending all this money are going to start recouping some of that?
Bob, let me ask you this too while I have you here, because I know that you talk to these executives frequently at these various companies. And we've all been having this discussion in the markets about circular and about questioning the ROI, this question you just asked. How they're cognizant of it, I would imagine, the executives. But what are the vibes among those executives about these questions? Do they seem nervous? Does it seem like the stakes are high because they're spending so much money?
I got to be honest with you. In some of the conversations I've had and participated in small group discussions, people are pretty confident. They're feeling like, hey, right now, let's, get it while the getting's good kind of a thing. And,
interesting.
There is that sense of that. And, look, people are raising some questions. But right now they're focused on, look, we have all this crazy demand out there. Let's do everything we can to take advantage of it. Let's see what kind of pieces we can put into place to try and keep it going as much as we can. So I do feel like the confidence is pretty high. So it would take a couple of different things to really knock it down. That's the other thing is like, everybody's looking for a stumble, and you say, oh, maybe that's a stumble, right? And then you're like, yeah, but that's one little piece of a much bigger thing. So in my view of what's going on is, unless we see several pretty big stumbles, I think confidence runs well into 26. And then, this time next year, again, if we haven't seen some of those business model changes, we haven't seen more of the ideas around how do you actually make money. Like, hey, if OpenAI and everybody cuts you off and say, sorry guys, we know you love using our stuff, but you ain't getting it unless you pay for it.
Yeah.
I mean, at the end of the day, it's not like rocket science. Somebody's going to have to do that. The question is, will enough people pony up to justify it?
It's a great question. We'll find out sooner or later. Bob, thank you.
Thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. We will be joined by an IBM executive and the CEO of Confluent next. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. As we take a look at the major averages, they've turned negative now. Not a big drop, but nonetheless, seeing some declines across the board with the Dow lower by about 200 points here, the S&P 500 pulling back by 0.4%, and the NASDAQ off by 0.25%. We got a big deal to talk about today. IBM will buy data streaming platform Confluent for $9.3 billion in a major bet on enterprise software. Now, this acquisition builds on a 5-year partnership between the two companies. And joining us now is Jay Kreps, Confluent co-founder and CEO, and Rob Thomas, IBM's Chief Commercial Officer and Senior Vice President of Software. Guys, thanks for being here.
Excited to be here.
Rob, I want to start with you because as you guys have obviously made a number of large acquisitions over the years. This is on the larger side of them. And so how did you decide that now was the right time to look to a company like Confluent? And how are you thinking about what it's going to bring to the operation?
I think we're at a unique moment in time with everything happening in AI. Our projection is there's going to be 1 billion new applications built using generative AI over the next 5 years. And that needs a data platform to feed it intelligence. And Confluent is without a doubt the leader in real-time data, how you can connect the data, transport data, and then process data. And they have an incredible track record, over 40% of the Fortune 500 today. We think this is the perfect time to bring Confluent into IBM and bring it to the whole world.
And for you, Jay, help people understand a little bit what Confluent does, because I think for people who are not steeped in the sort of pipes of how generative AI works, they would think, oh, well, isn't real-time data just like part of it? But it doesn't just sort of magically happen. So talk to me about how it happens.
Yeah. You could think of Confluent as kind of like being pipes. It's ultimately about how does data flow across the different parts of a company, between all the different applications. How can a company kind of act and react to what's happening in real time? Yeah, it's a big deal for a lot of these AI applications because they're fundamentally about bringing context to data together, in real time to be able to feed these models the right information to make good decisions.
And Jay, why did you guys decide that now is the time to say yes to IBM and not remain an independent entity?
Well, IBM has an incredible track record with open source and with acquisitions and really accelerating them. And I think it's done an amazing job of building an open platform for hybrid cloud, for applications around security, that has taken these acquisitions and built something that really makes sense for customers. And I think to me and to Rob, when we thought about combating, a layer that was open around data and the flow of data across the company, we felt like, hey, that makes a lot of sense. And when we thought about our customers, that's what they're looking for and the problem they have to solve as they think about really harnessing this data for the next generation of AI and applications and development they'll be doing.
Rob, talk to me a little bit about the financials behind this. I know you say in the statement that the acquisition is expected to accelerate IBM's growth over time. Maybe you could put a few more numbers around what exactly that growth might look like. And I also should note, Confluent is now does not make a net profit at this point. So I wonder what that trajectory is going to look like under IBM.
Confluent's a very successful business. So $1 billion of revenue growing 20%. So we're very positive about the fundamentals of this. And we also said that this will be accretive to IBM's free cash flow in year 2. And so we're going to look for synergies as we do this, but we're going to continue to invest more into what they're doing in R&D because they've got the leading product, leading platform in the world for real-time data. And then we'll look for different opportunities for synergy as we go too. But the fundamentals here are very good. And I'll tell you, we're impressed by how they've moved towards a consumption business model as well. So they're really hitting clients with the way they want to consume technology, which I think is great.
So just to get a little bit more specific there on that profitability piece, the growth and the size of the revenue at Confluent, Rob, totally get that. When you bring it under the IBM umbrella, do you switch, how quickly do you switch that on to profitability?
Well, we haven't changed our model and our guidance, but as I said, we'll be free cash flow accretive in the second year. So we're going to be aggressive about thinking about how do we optimize the business model of Confluent in IBM, but we do that right away, just like we did with HashiCorp, just like we did with Red Hat before that. We're really focused on how do we get synergy quickly.
Jay, you guys compete with some of the hyperscalers with your business. Now that you're going to be owned by IBM, kind of how does the pitch to clients change or does it not change to sort of reassure them now that you're owned with a company that competes with maybe some of your clients on some fronts?
Yeah, I mean, there's some products within the major public clouds that we would compete with, but there's hundreds that we actually cooperate with. So we think about the hyperscalers as partners. Our platform connects into many of their offerings and would drive the flow of data and consumption out to many of their AI and data services. And so even though there's a handful of products that we would overlap with and compete with, by and large, we see it as complementary. And I think that continues as part of IBM.
And Jay, I'm curious, as you sort of visualize what Confluent looks like with IBM, is there a hero product that you envision, having the two companies coming together that you're going to be able to offer to customers?
Yeah. I think the vision, is very much an extension of what Confluent has helped to date, which is to really provide a fabric across all the parts of the company, right? The different clouds that they live in, data centers out on the edge, where data can flow in real time, that connects all the parts of their business that they can act on, that they can bring intelligence and AI to. This is what we enable. I think we're now able to do this as part of a bigger story for some of the largest customers in the world. And I think that's a really exciting thing.
And Rob, finally, expect any kind of regulatory issues with getting this deal through?
No, we're very confident. We'll go through all the process because we want to do things the right way as we always do. But expect that, as we said this morning, hopefully we'll close by the middle of 2026 and then we'll be off and running.
I see a red hat behind you. I don't know Confluent. What would signify a Confluent? Oh, you got the logo.
We don't have a red hat, but there is a logo back there.
Yes, got it. All right, guys, thanks a lot. Jay, Rob, appreciate it.
Thank you.
Thank you.
Coming up, we're going to take a look at what to expect for the IPO market in 2026. Stay tuned. You're watching Market Catalysts. The IPO market has sprung back to life in the second half of 2025 after a pullback caused largely by tariffs imposed by the White House. Many on Wall Street are hoping that rebound continues in 2026, and that may just happen with names like Anthropic and SpaceX among many putting plans together to go public. Let's take a look ahead with Brianne Lynch, Equities and Head of Market Insight. Brianne, it's good to see you.
Good to see you too.
So we had a little bit of a hiccup in momentum because the government shut down. So the SEC was closed. So the IPO filings were not going through. Did that sort of are we seeing the momentum sort of pick back up? What did that cause in terms of the rhythm of the IPO market?
Sure. What we saw was the government shutdown slowed the near-term momentum, so there are probably fewer end-of-year IPOs than initially expected. But what that's done instead is created an even more robust pipeline of companies in 2026 that we expect to go public. So when we look at the companies on our radar, they really range in industries. You've got blockchain and crypto companies, fintech companies, AI hardware companies, SaaS companies. So a lot of different industries, but the one commonality that they have is that these are mature late stage companies. So the average company is 12 years old. The average last round of funding is a Series F. So we're seeing mature companies that have raised a lot of capital in the private market, seeing now as a more opportune time to test the market.
Well, and that also means that these IPOs are going to be enormous in some cases, bigger than we've ever seen before. I mean, the latest funding round for SpaceX reportedly $800 billion, which is just kind of mind-blowing for an IPO. Anthropic reportedly valued at about $183 billion. And by the way, you can track all of these numbers on yahoofinance.com on our private valuations page. When these IPOs are that big, what is the demand going to be? What do you think the investor perception will be of further upside when the companies are already that mature?
Yeah, that's really the billion or trillion dollar question. When a company is a multiple centicorn. We're talking about $800 billion valuations. The growth question is one thing, but I think the demand question is separate from that. What we've seen in the private markets is that SpaceX is by far the most popular private company. So investors want to invest in SpaceX, and that type of market demand, especially since the average investor cannot invest in these companies, is going to trickle into the IPO market, where it's the first time that most investors can access some of these top innovators across industries. The question about how much growth is left is a real question, though, especially when companies have reached this scale. These are companies that 20 years ago undoubtedly would have already been public. So it's a question of what is the growth story that they can tell for the 5, 10, 20 years post-IPO, and is that compelling enough for investors? What we're seeing because of this, though, is more investors than ever are coming to the private markets to be able to participate in that growth a little earlier.
And so which do you think are going to be the most compelling for investors? What are going to be the hottest IPOs next year?
Sure. So when we look at popularity score, which is a proprietary metric on EquityZen's platform, the most popular company on our list is Cerebras. So they create supercomputing chips that are really core inputs to the AI machine. And one of the core AI infrastructure pieces that allows that technology to scale. So this is a company that filed last fall to go public. They actually pulled their filing last month, but they still plan to go public. So their CEO has made it clear that we're pulling our filing because we want to be able to update it with the latest numbers that show our growth. So that's going to be a really interesting one to watch, just given the popularity of both AI and that company specifically. When it comes to the other two most popular companies on our list, we see Kraken and Databricks. So Kraken, a crypto exchange, and then Databricks, an AI-driven data platform.
So that also makes it seem like the themes, the sectors next year will be very similar to the sectors this year. That is, you've got some AI, you've got some fintech, you've got some crypto.
Yeah, those are definitely the sectors that make up the lion's share of the companies on our list. It's where there's the most investor demand, and also the areas where we're seeing the most innovation and regulatory frameworks that are supportive of those industries. So those industries still remain the leaders. There are some others on our list, but when we look at the most popular industries amongst investors, they fall into fintech, AI, and pure tech. So aligns with that as well.
And then you think the first IPO of the year could be a company called Wealthfront?
Yeah, so Wealthfront actually is likely to go public this week, so we'll really, be off the list before the year even begins. But this is a company looking at a $12 to $14 billion range for $12 to $14 range for their IPO, which is about a $2 billion valuation. And it was a company founded in 2008, so a company that's been private for 17 years. They were really an early innovator when it came to robo-advising, something that's gone, very mainstream now. So it'll be interesting to see how much the market values that technology, given how much it's been proliferated in the market.
And Bran, since we're talking a lot about, sort of the similar themes next year, or just maybe bigger, is there anything that you think will surprise people about the IPO market next year, or that has surprised you as you prepare?
I think what we still haven't seen when it comes to IPOs is a pure play AI company, and that's because this technology is inherently young, and therefore these companies are earlier in their life cycle. So we've seen some AI hardware companies, we've seen some AI adjacent companies, but there are very few opportunities in the public markets to get pure AI exposure. So the fact that Anthropic is talking to lawyers about a potential IPO, I think that's one that would be extremely interesting to watch. And talking to lawyers does not mean an IPO is coming. There's so many steps that have to happen after the course, but the fact that they may even be exploring a 2026 IPO is surprising. They were founded in 2021, so would be a 5-year-old company, a baby compared to the others on our list, but I think that's going to be an area that draws the most investor demand.
Yeah, baby in age, but not in terms of market cap, Brianne, it looks like.
Not at all.
Yeah, so we'll see if that does play out that way. Good to see you. Thanks so much.
Thank you.
Coming up, we're taking a look at some of today's top trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live here at the NASDAQ here in Times Square. Let's get a quick check of the latest market action. We're about 2 hours into today's trading session, and we're seeing red across all 3 major indices. Taking a closer look at the Dow, we are seeing the Dow move down about 0.3% lower. The S&P 500, a similar loss today, down about 0.3% as well after opening in the green. And the NASDAQ seeing a similar story there, down about 0.2%. Diving into what exactly is leading the NASDAQ lower, we do have Netflix as one of the top losers so far within this trading session after Paramount made that all-cash deal offer worth about $30 per share or $108 billion. Now, keep in mind, heading into today, Netflix had offered to buy out Warner Brothers Discovery for about $72 billion. Now, there are some concerns on the street that Netflix will have to up their offer. There are also concerns on the street that Netflix won't get approved to buy out Warner Brothers Discovery due to by regulators due to the market share that it would gain from this deal. So we're definitely keeping a close watch on Netflix. Also bringing down the NASDAQ today includes Tesla and Intel, but the Mag 7 sees a bit of a mixed picture with Google down, Meta and Amazon also down, whereas Nvidia and Microsoft in the green today. But I also want to take a look at some other companies that we are watching this week. Let's take a look at software stocks because we are expecting to hear from Oracle on Wednesday. This company going into this report on Wednesday, December 10th, it's down about 2 months. Over the past 2 months, it's down about 24%, down about 8% over the last month alone. And analysts are really looking for greater clarity on the upcoming CapEx cycle and financing. And if you take another step within AI as well, also taking a look at semiconductors, Broadcom also expected to report on Thursday after market close. This one a bit of a different story heading into the report, up about 15% over the past month and up about 16% over the past 2 months. But analysts here really hoping that this company can confirm that it's seeing robust demand within this AI revolution. Taking a step back, though, all 3 major indices are in the red to kick off today's trading session and this trading week. Once again, the Dow, NASDAQ, and the S&P 500 all moving lower this morning. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the session.
Paramount Skydance launching a hostile bid to buy Warner Brothers, offering an all-cash deal worth $30 a share. This comes after Netflix won the bidding war for Warner Brothers movie and streaming unit. Joining me now is Geeta Raghunathan of Bloomberg Intelligence, senior media analyst. Geeta, just when we thought this thing was done, or maybe suspected it was done, we get another twist and turn in this. And we're learning some interesting things also about the financial backers for Paramount as part of this. But let's start with just where we are today. What do you think the outcome of all of this is going to be?
I mean, I don't know. It's anybody's guess. But the good thing, I think the winner is definitely Warner Brothers Discovery, because you have here 2 very, very interested bidders who are willing to go all out, Julie. I mean, we saw Netflix kind of make that deal for about $27.75 per share for just the studio part of it. Paramount, of course, coming in with $30 a share. Of course, this all rests on where Paramount is kind of valuing the TV networks unit, because remember, they are buying all of Warner Brothers Discovery, whereas Netflix is only going for the studio and streaming segment. And Paramount basically valuing the TV networks at about $1 a share. The street view is much higher, I would say, at about $3.50 a share. So that's where we're seeing a little bit of the delta. So I think the street still views the Netflix offer as the superior one, but Paramount really kind of promising regulatory certainty, speed of completion, and of course, as you brought up, the financing part as well, not to mention the fact that this is an all-cash bid.
The financing is interesting because apparently there are some sovereign wealth funds, financing partners from the Saudis, from the Qataris, the Emiratis, who have said in exchange for this, they are actually going to give up governance rights. So, having a say in the deal and in the management of the company, maybe in exchange for some behind the scenes influence, if you will. How does that affect how people see the deal or the regulatory approval of the deal, or does it not?
I think it matters, and I think that's why Warner Brothers Discovery was concerned in the first place, because as you know, there was some reporting that that suggested that all of these sovereign wealth funds were involved, that maybe there was some Chinese money that's involved, and of course that is going to trigger a regulatory review. And I think that's one of the reasons why Warner Brothers Discovery was hesitant on proceeding with Paramount Skydance. Paramount Skydance, of course, rebutting and saying that the whole deal, the equity portion, is backstopped by the Ellison family as well as Redbird Capital, and that should give Warner Brothers Discovery enough confidence in terms of the financial portion of the deal.
Geeta, I've also been sort of fascinated over the weekend to read some of the Hollywood players who were resistant to the Netflix takeover, because there is this perception, I guess, in Hollywood that Netflix has not been a positive force on the art of movie making. And I'm curious how you think about that, and how you think about that then as, in terms of the business proposition for whatever this combined entity ends up being, and would Paramount be more positive in that sense?
Paramount is claiming that it will be more positive, and I think they will be. I mean, this is at its heart, if you think about what David Ellison really wants to do, it was to kind of buffer his whole movie business at Skydance, right? Which is why he was so actively and aggressively chasing Paramount. And they have made public commitments. Paramount was producing about 8 movies a year. They have publicly said that they're going to up that to 15 movies a year going forward. And if they are successful in winning the bid for Warner Brothers Discovery, that output will go to 30 movies a year. Now with Netflix, of course, we know that they have had a very vehement anti-theatrical stance. They've always wanted to put movies day and date straight on their streaming service. So, Hollywood obviously is not unjustified in being very, very concerned about the future of the theatrical business. So it's, again, so far Netflix saying all the right things, saying that they are not going to in any way stop or thwart the release of Warner Brothers movies in theaters. But again, who knows what happens once the deal actually closes.
Well, and at the end of the day, is this basically a political question? We've seen the Trump administration making decisions based on personal relationships and political relationships, for that matter. We know that the president is close with the Ellisons, although we also know that he said Ted Sarandos came calling also. So how are you weighing that, something that you're probably not used to having to weigh this much as a financial analyst, right? But how are you weighing those types of relationships?
Yes, so much of, so many twists and turns, as you rightly put it. And that's kind of the wild card here. Nobody really knows how this is going to play out. If you kind of look at it from a mathematical perspective, Julie, just looking at the shares of the streaming platforms themselves. So Netflix, obviously the number one global streaming service, over 320 million subscribers. You put that with HBO Max, you get another 120 million. So this becomes, that is a huge portion of the market. But Netflix really arguing about how do you define the online video market? Are we only counting Netflix, HBO Max, Amazon, or should we really be taking into account Reels, TikTok, Instagram, YouTube Shorts. Should we not be considering all of that? Because that's where we're seeing a lot of the eyeballs go these days. And so there is this whole question of category ambiguity. I don't know exactly how it's going to play out with regulators. In the case of the Paramount Warner Brothers deal, it seems like the regulatory path might be a little bit more simple, just because you don't have such dominant platforms. And even in box office share, I don't think they trigger any big red flags. But again, this is all up to the whims and fancies of the Trump administration. So we'll have to wait and watch.
And just seeing here that the Paramount executives say Warner Brothers has 10 days to respond to the offer. So we'll see if we have this wrapped up before Christmas. Maybe, maybe not. Geeta, great to see you. Thanks so much for hopping on.
Thanks, Julie.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Americans are cutting back on one of the country's most reliable comfort foods, pizza, opting for smaller pies, fewer toppings, and skipping sides. Yahoo Finance's Josh Lipton spoke to Hockey A.K. Dennis, founder and CEO of Champion Pizza, about the cautious consumer.
Hockey, it is great to see you. So people understand, founder and CEO of Champion Pizza, we were talking off camera, you've got 15 years of experience, you got, I think you said 17 locations. So there was a headline, Hockey, and you're the man to ask about this, all right? This is the New York Times headline. Here's what they said. They said, people are ordering now smaller pizzas, they're getting fewer toppings, and so it sounds like people may be getting more cautious, maybe they're a little worried about money. I'm just curious, is that what you're seeing in your 17 locations? Does that make sense to you? Is that the trend you're seeing?
It does. By the way, thank you for having me today.
Of course.
Yes, it happened pretty much almost every single day, especially like after COVID, with this all inflation, all this prices going up. I'm gonna say like one lady, she came to our store, and she wanna buy a large pie, and with large pies cost like $21, and then she wanna put obviously each topping is like $5. Pepperoni, mushroom, peppers, whatever they wanted. So she want to add 4 topping. It's going to be like $41. She said, no, never mind. Could you, true story, yeah. She said, would you just put pepperoni? That's it.
Yeah. So you see it. Now let me ask you that. When you see this trend, do you think that's people getting, maybe it's some affordability issues, it's economic anxiety issues? Is that what you would chalk it up to? Or, because I've heard, or maybe could it be competition for other foods, maybe diet habits are changing, GLP-1s, there's all kinds of things that could be going on.
Well, I mean, everything is a one package. You cannot just, point to one. Obviously, economy. People, that they work so hard, but there's not enough. Like single mom, they have 3 kids, to just, every day, the shop around is not enough sometimes. And it's everything.
So let me ask you, you got 17 places to run, you got businesses to run.
Yeah.
If that's a trend you're seeing, if you're seeing more people coming in, initially they say, I'll take 5 toppings, and then they see, well, hold on a second, that's the bill, I got to dial it back. How do you manage that?
Well, I mean, to manage this one, first you have to feel other people feeling. And the first one I opened my pizza shop in 2010 in Lower East Side, Champion Pizza. I used to sell 2 large pie with 2-liter soda, $19.99, $20. Today, same pizza, same drink is almost $50.
Wow.
So I mean, it's obviously everything is just not double, it's a triple. It went up a lot.
How
a lot of people. I'm sorry.
So let me ask you this:
Yes.
if you're dealing with food inflation,
yes,
ingredients are going up, prices are going up. Are there certain ingredients that you see really going up?
Yeah, pepperoni. I used to buy for $30 for 10 pounds. Today is $130, $140.
Wow.
Yeah, seriously.
Yeah.
It's a way chicken, tomato sauce. I imported tomato sauce from Italy. The one I use is organic. It cost me $15, I think it was $16 back in the day. Right now it's $75.
Unreal. So let me, then how do you sort of navigate that, Hockey? Do you say, okay, I'm going to eat that, I'm going to take a profit hit, or do you have to raise prices?
Be honest, the price, I mean, back in the day, cheese slicer was $2.50. Today it's still $2.50. So you cannot like it's $2.50 jump to $10. You cannot do that. You have to have a heart for other people feeling. I mean, a lot of people, they're struggling, brother Joshua. You see that a lot of people, people, they struggle to buy even like one slice sometime. A lot of homeless people live in the street today. They don't have like $1 even to buy like $1 slice. This life is sometimes tough. It's not fair enough for everyone. Life is very, very tough, man.
Let me ask you this. Another trend I've seen, I'm just interested because I've heard other pizza owners reported this. On the GLP-1 thing, that's a trend, right? I've seen some pizza owners saying they're trying to actually capitalize on that. Maybe they're trying to make a pizza like less calories, more protein. I've heard like cauliflower crust. They're trying to find all ways around what is a really popular new medicine. Are you doing that?
Well, I mean, this is good for health. A lot of people, I'm sure you go to gym and see that,
I appreciate that. A little bit. It's nice on camera. It's nice to say. It's nice to say.
I mean, pizza is a pizza. The bread is not. When you bake the oven, you kill all, a lot of calories in there. And this tomato sauce is very healthy for you. The cheese, a lot of calcium there. It's not bad pizza for you because you bake. Anything baked is good for you. It's not fried. So the cauliflower crust, I don't want to against him, but that's not me.
It's not for you.
Not for me.
Let me ask you this. I got to ask because you're here. You run 17 locations.
Yes, sir.
In the Lipton house tonight, it's Friday night. We're going to be ordering pizza. When you order pizza, what's your go-to pie? You don't have to pick one. Maybe it's a couple options. It could be on your mood, Hockey.
I like margarita.
Yeah.
I like margarita, and that's my favorite pizza. I always go Lombardi's. That was the first pizzeria. They opened 1905 in Soho. I go over there always. I go with my family. I get margarita pizza. Even my pizzeria, I always get either cheese or margarita.
Hockey, I'm getting hungry just hearing you talk about it. Thank you, sir. It was great having you today. Appreciate it.
Yeah.
2025 is nearly a wrap, and we just got a couple of nasty credit scares on the tape. JP Morgan CEO Jamie Dimon is calling them cockroaches. If you see one, there are probably more hiding. So investors are asking a very simple question. With the Fed still in cutting mode, are we heading into a safer environment for stocks or into a new round of credit trouble? BofA's Savita Subramanian looks at the data and says we might be due for a credit cycle, not in 2008 or not like 2008, but a phase where borrowers get squeezed and lenders, they get pickier. So the top gun question of the day that we're answering on Stocks in Translation, as we fly into 2026, is the air still clear or are we quietly entering the credit danger zone? Let's start with what a credit cycle even is. It's simply the rise and the fall of available credit in the economy, specifically in bonds and loans that companies use to borrow. When money is easy, everyone gets a loan. And when money tightens, only the strongest borrowers make the cut. If you've ever seen your credit card limit go up in the good times and then get cut back, you have lived a mini credit cycle. Now to the big questions for stocks. This Foursquare shows how stocks have historically responded to different Fed and credit backdrops. When many of us hear that the Fed is cutting rates, they think green light. But BofA reminds us that if the Fed is playing catch up and the economy is actually heading into trouble, the worst box for equity is the bottom right one. That's when the Fed is cutting while the credit is tightening, the real danger zone. And that's when growth is slowing. That's when lenders are pulling back at the same time, even as rates are falling. So earnings get squeezed and investors start hitting the sell button. The open question for 2026 is whether we have drifted into that box. So what makes this potential credit cycle different from the global financial crisis? Well, back in the GFC, the problem sat inside bank loans and housing. Today, the risk has shifted to private lenders and shadow credit. Instead of housing and banks at the center, BofA flags growth, media, and cable borrowers as the new hotspots. And whereas public bond loan markets were the story last time, this time around, private credit markets are seeing higher default rates than traditional high yield. So where are we right now on the stress meter? This blue line right here is our stress barometer. It's the price of a 10-year Treasury ETF, IEF, divided by the junk bond ETF, HYG, and this is going back to 2018. Think of it very roughly as a VIX for corporate credit. When the line spikes, investors are dumping risky corporate bonds and hiding in treasuries, the danger zone. When it drifts lower, credit is generally easier. And that big spike in the middle shows what happened in the early pandemic when credit market froze, right here. But if you look where we are at the far right of the chart, we're actually off of the 2025 lows, but still pretty muted versus history. The biggest spike in 2025 is the post-Liberation Day risk-off moment. But those two cockroaches Jamie Dimon was talking about didn't register much, so it's quite possible they were just one-offs as opposed to warnings of systemic risk. So what belongs on a credit danger zone watch list? First, watch high yield bonds versus treasuries. Let me get that clear. Well, that's not going to cooperate. As treasuries, as we just laid out, are investors still willing to own risky corporate debt, or are they running back into the arms of Uncle Sam? Then keep an eye on regional bank stocks, ticker CARET KRX. These are the lenders to small businesses and also local real estate. If they start rolling over while the Fed is cutting, that is a red flag. And watch headlines for media and cable debt troubles, That's one of Savita's new risk areas, and it's where streaming battles and cord cutting meet higher interest costs. Then, are weaker companies still able to refinance and roll their debt? Cracks show up in smaller, weaker companies first. And then finally, don't forget Main Street credit stress. Watch consumer credit card auto loan delinquencies and households. If they start falling behind in a big way, guess what? Jamie Dimon's cockroaches move from the private credit basement into the living room. Bottom line, we're nowhere near pandemic territory and much less of the global financial crisis. That's in the rearview mirror. But investors will be on alert for that danger zone as 2026 develops. And tune in to Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Ed Yardeni research president and a Wall Street veteran, making some waves this morning with his latest call, writing, quote, "It no longer makes much sense for us to continue recommending overweighting the information technology and communication services sectors in an S&P 500 portfolio as we have since 2010. Ed's joining me now to break down why he's making this call and some of the risks facing investors with increasing market concentration. Ed, thanks so much for this. This is a big change for you guys, we should say, first of all. So for 15 years, you have said overweight, not just big tech, but also you have been bullish on the Magnificent Seven, right? And so what has changed for you? What was the sort of tipping point that changed your thinking on this?
Well, they've worked awfully well to the point where if you look at the S&P 500, information technology and communication services, just those two sectors out of the 11 sectors in the S&P 500 account for 45% of the market capitalization of the S&P 500. So we really have had a tremendous amount of concentration in just two of the 11 sectors. And that in turn suggests that maybe it's time to look elsewhere. It's hard to recommend overweighting something that's already so overweight in the S&P 500 relative to its importance in the economy. So I'm recommending continuing to overweight, maybe adding to overweights in financials, in industrials, and now also recommending healthcare, which happens to be one of the biggest industries in America.
And just to sort of level set here, for people who aren't always familiar with the way we talk about things on Wall Street.
Sure.
So the S&P 500 has a certain percentage of it is made up of tech and healthcare, et cetera. That
Correct.
percentage for tech is now 45%. So when you say overweight, you mean people should hold more than the weighting in the index would suggest.
Than the index, correct.
If you're neutral, it's the same. If you're underweight, you hold less. Yeah. Right.
Yeah,
so just so people know what we're talking about.
Yeah, exactly. I'm not recommending that they go from 45% to 65% in their own personal portfolios. Quite the opposite. I'm saying 45% already seems to be an awfully stratospheric percentage share of the market, and it's probably a good idea to look for some rebalancing of the portfolio. In other words, I'm arguing for some diversification. And that's been the concern that a lot of people have had, is that the market itself, the S&P 500 is a portfolio. There's a committee that actually picks that. And that portfolio right now is very concentrated in just two sectors. And I'm just saying that relative to that portfolio, you might want to trim back a bit and have certainly no more than what the index actually has.
So, Ed, though, to your point, it has worked well for quite a long time. And as long as it's been working, we've been having that market concentration debate, right? And people have brought it up as a potential issue. So it would seem to suggest to me that it is not just concentration alone that's the issue. Maybe you also, do you think that there are growing risks at all to that dominance that we have seen?
Well, the Magnificent Seven, the information technology sector generally is very competitive, and it's become more competitive. Maybe a useful analogy of the Magnificent Seven is the Game of Thrones, with that opening credits where they show the various kingdoms and how some are rising and some are falling. And for a long time, the Magnificent Seven all seemed to have a moat around them and could just kind of maintain a certain monopoly in the kind of businesses they have. Now with AI, it's kind of the Wild West for them. They have to suddenly spend a lot of money. They suddenly are saying that they're competing against each other after all. And then there's all these startups. There's almost no barrier to entry in the information technology these days. Anybody with any sort of cockamamie AI ID may very well get funded and come up with something that could create large language models, these AI models, cheaper with chips that aren't as expensive and don't need as much air conditioning, and all that's on the way. So there's a lot of dynamics going. It's kind of like a horse race that just will never end. For a while there, it looked like NVIDIA was ahead of the pack. Now it looks like Google is ahead of the pack, but that could change from day to day.
Yeah, and I don't know where the red wedding would be in this analogy if we're sticking with Game of Thrones.
We don't want to go there.
No, we don't. So Ed, you mentioned, and I know you're still bullish on the S&P 500 overall for 2026. 7,700 is what you're looking at there. So talk to me about those other sectors that you mentioned and what you think could be catalysts there, something like healthcare, for example.
Well, I'm telling everybody to, be a little less exuberant about the technology companies, the ones who produce technology. I'm basically arguing that the S&P 493 outside of the Magnificent Seven, that they are technology companies. Every company now really has to be a technology company. You either make it or you use it. And I think more and more companies are going to find that the technologies that the producers are coming up with, both in terms of hardware and software, do lend themselves to increasing efficiency, to increasing productivity. And you've got to do that, because if you don't do it, your competitors will do it. So the healthcare industry, I can't think of an industry that's more ripe for technological innovations to increase productivity than healthcare. We all know just how, go doctor to doctor or hospital to hospital, how you have to fill out the forms and how long these things take. Well, now I see signs, just in my personal observations, that things are changing very rapidly in the healthcare industry to provide more productivity. There's something called EPIC, where the hospitals now share digitally their information about patients. So you don't have to kind of go to some office at one hospital to get copies of a disc to show a doctor at another hospital. So there's a lot of that going on. Financials, fintech is really a hot development. We are going to see more and more developments. Stablecoin, I think, is going to be sort of the Venmo for the financial system, broadly speaking.
Right.
I still don't know why we deal with checks, quite honestly, and I think that'll be gone pretty soon.
Well,
and industrials, same story.
Well, listen, if the penny can go away, we can probably say goodbye to checks at some point in the near future. Ed, thank you so much. It's great to see you. Good to get your perspective as you change your views. Appreciate it.
Thank you.
And that's it for Market Catalysts. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.